Do you want to go first? Or?
No, go ahead.
Okay.
As we both start. Historically, as we've gone through regime changes in the market, right, there have been pockets that have opened of opportunity for various players to step in. And I think historically, especially since the 2008 crisis, private markets have filled a little bit of that vacuum that we've seen. So the growth of private markets within private credit in particular has taken off a lot. And I think you'll continue to see that trend.
Some of those challenges in particular are about just increased expectations around transparency and understanding this asset class in a more meaningful way than I think has been required or expected in the past. And with it also introduces a whole new range of risks in terms of thinking about what you own, thinking about the market impacts to those exposures, and thinking about the liquidity components of within the private markets.
Overall, though the investment set is certainly smaller and maybe the conditions are more difficult, there's always opportunity in the private market set, and LPs and institutional asset owners continue to look to allocate to private markets to ensure that they're meeting their return hurdles that they have in place.
I do believe the opportunity trumps some of the challenges and risks that the industry is facing, and just want to make sure that the focus stays there. And again, when we think about building our products, engaging with clients, it's all about driving the best outcomes, helping them capture those opportunities, and then, yes, providing the tools to manage challenges, manage risk, but all kind of centered around the great opportunity we believe exists.
Risk means a lot of things to a lot of different people. But if you think about a framework for defining it in the private market space, right, it's multifaceted. So you can think about things like investment risk. So what's the the impact to a certain portfolio investment given market conditions? So you have things like concentration risk, you have exposure to underlying market factors, you have the ability to exit an investment or get distributions if you're the GP or the LP. So this is one form of risk, this kind of overall investment risk. You have liquidity risk or call risk, right? So if you're the GP, I think we've seen a little bit of a scramble in terms of identifying the different banks that you're getting capital calls from, given a lot of the crisis that's underway right now. And if you are an LP, being able to come up with liquidity to meet a capital call is a risk that you pose because you might need to sell into a down market on the more liquid side of your book. There's also operational risk, so being able to track all of the investments you have. Again, this is multifaceted from both the GP and the LP perspective, whether or not you're monitoring a book of portfolio companies, ensuring that they're reporting in a timely manner, you have structure around the financial metrics that they're reporting, or if you're an LP, just getting your hands around the vast sources of data that are required to manage a multi-fund book across many different private asset classes. And then finally, I think something that's often overlooked but becoming even more acute kind of in today's market is the reputational risk or reputation risk that's out there. So particularly for GPs, as they come into a phase where they're going to need to start exiting investments at some point, exiting into a cold market, so trying to offshoot either to a sponsor or to IPO a company out, or another form of sale can often be difficult. And so if you have a down round or you have particular risk in individual investments, that can hurt your ability to fundraise later on. And so being able to monetize those investments is going to be absolutely critical for a lot of these GPs.
And we are hearing from our clients that they are looking to take a much more sophisticated or advanced approach towards risk. I'm really thinking about at the portfolio level, so both bottom up and top down. So yes, understanding what you own at the asset level and getting the data to look at those assets individually, having consistent assumptions across your portfolio, and we would say really moving more into a space that we've seen traditionally in Aladdin for public markets investors and how they think about risk. Now, of course, it's not there yet, but we're definitely seeing a shift in interest and demand for more sophisticated risk management tools as this evolution occurs.
One of the real changes we've seen, particularly recently, like you mentioned, is the move away from idiosyncratic analysis into more structured analysis. And that's maybe a little bit, again, like thematic general when you look across the board. It's not just in the modeling space, but it's also in the workflow space. It's also in the deal assessment space. And so trying to implement centralized systems and workflows that are configurable enough to meet the needs of all the different investment desks that one has in an organization, again, whether you're an LP, looking across different funds, if you're a GP looking at sourcing individual deals. I think the key is structure at this point, just because that affords you the ability to collect data. And ultimately, once you get to that data collection phase, that's what opens up a lot of doors for you, whether it's going to be, again, the measurement of risk, whether it's going to be, looking at things like liquidity or other factors in the market.
So more and more of our clients are looking at their public and private markets exposures holistically, and want to understand risk holistically across those exposures. So looking at a specific sector that you might be exposed to, and both the public and private markets assets that make up that exposure, and looking at risk in that lens. It's a very new and more comprehensive way to think about it. And we'd say we've worked really hard over the past few years to build the tools to enable that.
Now private markets are competing a little bit more
Yes.
with the other asset classes for allocations amongst investors. And so maybe that does help spur transparency, data collection, and more investor-centric approaches rather than just always performance.
Yeah. Can we do another one?